As I say, Nick is co-manager on the trust alongside John Yakas and George Barrow. Nick has approaching 30 years of experience in the financial space. He's been with Kohler Capital since September 2010, when they sort of acquired the Hiscox Investment Management, which effectively established the firm's financials franchise. Prior to that, Nick's had an extensive career in fund management, focusing on financials, running a number of funds that have given sort of very strong outperformance. Okay, Nick, are you there?
Yes, morning, Matthew.
So, just kick things off. For those that are sort of perhaps not familiar with the trust, could you just perhaps spend a few minutes telling us, or perhaps giving an elevator pitch, telling us what it is that PCFT does and how you go about doing it?
Yeah, no, very, very happy to do so. If you flip over to the next slide, that probably gives a good start or introduction. So we manage 3 financial funds within the team, and the one we're talking about today is obviously the Global Financial Trust. It was launched back in 2013, really as a low-risk way for investors to play the recovery in global financials. Using our sort of milk analogy, the difference between these 3, you've got the skimmed version on the left. For those of a nervous disposition, provides an attractive, sustainable yield, invests in equities and bonds. Bookending the trust on the other end, the sort of full fat version is very much a slightly more growth version, more in mid cap, maybe more in some of the fintech stocks and emerging markets. And the trust was launched really as an income and growth vehicle. So, a good level of income, 3%. Which we've grown over that period since launch. The dividend's been maintained in the last couple of years. We can perhaps talk about that a little bit later. And if you go over to the next slide, then you can see, this is what it's providing. It's providing you that very much that global exposure to the sector. So a mixture of large, well-known, US and European and Asian banks. We give some examples there. Some mid-cap banks where we're seeing some really interesting growth opportunities in the US, but also within Europe. And then a mixture of insurance, which is the second largest weighting in the trust. And that's predominantly non-life. So you're thinking of, thinking about sort of auto, home insurance, but also some of the sort of big specialty insurers listed in the US and Europe, life assurance as well. So we give an example there, AIA. And finally, exposure to some of the things like stock exchanges, asset managers, and payments. Some examples there on the right. So, very much it's that broad exposure to the global financial sector and playing the themes across that. How has it done since we launched it back in 2013? The next slide sort of gives you some, actually we haven't got it on the slides we're sharing, but broadly the trust has returned about 110% NAV over that period. And to put that in context, a basket of UK banks will have fallen by around 5%. Now they've obviously done better in the last year or so coming out of the pandemic, but you've made no money owning a basket of UK banks over that sort of 8-9 years. Looking at some of the broad UK financials, you've done a bit better, but still it's about a 30-35% return. So very much the opportunity is investing, we think, globally. And the reasons behind launching it and the opportunity set we see now, what we try to highlight in this chart, which you can see in front, is that when you look back at what happened during the global financial crisis, banks understandably, fell substantially in absolute terms, but also underperformed, wider global equity markets. Now, the chart on the right shows what's happened over the pandemic, and to us, this is a big anomaly. Banks this time round have underperformed by, more than they did during the GFC. Now, for us, that doesn't make a lot of sense. Banks today have significantly more capital than they did 15 years ago in the run up to the GFC. Their risk appetite is much more conservative, much more cautious. Some of that is by their own, obviously their own decisions. Some of that is, driven by regulation. And you're getting a really attractive, a much more attractive risk-adjusted return buying into the banking sector, 15 years on from the global financial crisis. And that very much, sets up for what we, see as an opportunity from here. Obviously, what's interesting is, and you can see this slightly on the chart on the right, 2022 has not been a good year for financial markets, and financials included. I mean, they started off, well. You saw at the back end of 2021 central banks pivot. The sense realizing obviously that inflation was not proving as transitory as they'd hoped, and therefore the interest rates needed to go up more quickly than expected. That's obviously a big positive for financials. In the case of banks, you see their margins widen. The opposite of what we've had in the last 10 years of low and negative interest rates. Banks' margins have been compressed. That's reduced their profitability. And this is the reverse of that. So share prices have benefited from that. In the case if you look at insurance, rising bond yields, rising interest rates means obviously as an insurance company reinvest their maturing bonds or their cash, they're getting a higher return. You're also seeing insurance rates go up. We can touch on that a bit later. So the sector's a big beneficiary of this sort of rising inflation, bond yields and interest rate story. Nevertheless, the sector's sold off along with the rest of the market over concerns about the outlook for obviously growth and inflation and the impact, obviously of higher interest rates. And that's, actually makes it a really interesting point to discuss the trust and the sector today from the point of view of, where it sits. And if you flip over to the next page, you can see the impact of those sort of, moving drivers on the sector. So we've listed a number of, US banks here, most of which we own within the trust. And what the blue bars show is the earnings revisions year to date. And you can see you've had some, quite significant positive earnings revisions come through across the sector. And as obviously illustrated on this chart, US banks benefiting from obviously the rise, the rise in interest rates, expanding margins, and that feeding through to a better outlook for earnings. Nevertheless, share prices have to varying degrees, fallen quite substantially. So you've had a significant derating as a result. And that's because obviously markets, investors are worried about the outlook for growth and therefore what's going to be the impact for potential loan losses going forward from corporates and individuals, as obviously economies slow and potential for people to default on loans. So that is the very much the $64,000 question, and we can go into that in a little bit more detail. Okay. If you go over to the slide before, and what the interesting setup at the moment, this probably reflects what's going up, is if you look back over the last 10, 12 years, banks, this is globally, show a very high correlation to bond yields and interest rates. And that reflects that obviously lower interest rates, bond yields, margins get squeezed, and vice versa. So bond yields going up on the expectation that growth and therefore interest rates go up, the sector's outperformed. And so on this chart, you've got the dark blue line is the performance of, in this case, US 10-year bonds. And then the light blue line is the relative performance of US banks. And you can see this incredibly strong correlation really up to about 6 months ago. So around the time of obviously the Russian invasion of Ukraine and obviously rising concerns about the outlook. And at this point, the sectors diverged materially. And we put that all down to not concerns about interest rates in themselves, but concerns about the outlook for asset quality and loan losses going forward. And the difficulty with this is, to sort of, I suppose, paraphrase Galbraith, there's two types of forecasters out there. There's those who can't forecast and those who don't know they can't forecast. So our crystal balls know better than anyone else's. Very much we're pretty cautious about the outlook. But the interesting thing is, post-pandemic, what we've seen when we look at the data coming out from banks and other consumer finance companies is that asset quality has remained remarkably robust, surprisingly so. And the reason we think that reflects, you had this huge amount of stimulus during the pandemic. That was both monetary, but also fiscal. So furlough checks, you had the obviously guaranteed loan programs, so bounce back loans and SIBLs in the UK, or the PPP program in the US. Consequently, when you look at people's bank balances, they're materially higher, and this is across cohorts, versus pre-pandemic. And you're seeing this, both in the US, Europe, and elsewhere. So notwithstanding the concerns about the outlook, and cost of living crisis, and obviously anecdotal evidence we're seeing about people struggling with energy bills, actually you're seeing no signs of credit deterioration yet, which is remarkable. Jamie Dimon, Chairman and CEO of JP Morgan, quoted as saying a couple of months ago, credit has never been this good before. Mm-hmm. You had this, upside down, world during the pandemic, where normally you'd expect people to default on their credit cards, and actually people were paying down their, balances on their credit cards. Delinquencies on credit cards is materially better today than it, you'd expect it to be, normally. Now, having said that, quite understandably, we think that is going to worsen. You'd expect to hit, perhaps credit cards. You'd expect it to hit, sort of lower income cohorts, subprime lending. Maybe we're starting to see the first signs of that, but at the moment, that's yet to come through. So it's very much a waiting game to see that impact. And so that then leads on to, on the next slide is, well, when you're thinking about how to look at the sector, the outlook's uncertain. One thing we know is the market's a discounting mechanism. Historically, the sector sells off in the run-up to a recession. There's some analysis done by Autonomous research outfit that specialized in global financials. Pre-pandemic, they looked at the 12 preceding recessions in the US. In 8 of the 12, banks underperformed in the year preceding the recession, and in 8 of the 12, not quite the same 8, they outperformed in the year the recession hit, reflecting the fact that once people can see how the outturn for growth, inflation, interest rates, where it's going to bottom, they start to feel more confident about buying into the sector. The other way to look at it is, well, how are valuations at this point? And what we've done on this slightly complicated chart to explain it is this is sort of 25 years of data from MSCI. Every single month for the last 25 years, what's the price to book of the global bank sector? And then if you bought the sector in that month, what was your subsequent 3-year return? And on the right, sort of top right-hand side, you can see the sort of pre-GFC banks tended to trade on much, higher price to book multiples, reflecting their higher, return on equity, their higher profitability. You then have that bubble at the bottom, obviously the GFC returns, as, obviously bank share prices fell significantly. They had to raise capital at, deeply discounted levels. That destroyed, obviously, shareholder returns. And then on the left-hand side, you can see, what the returns have been like versus the price to book post-GFC. And the surprise, when we put this data together was just how strong this correlation is. When you look on the left, the lower the price to book you've paid, all things being equal, the higher return that you've got, and vice versa. So today, with global banks trading around 0.95 times book, that would suggest, sort of 20 to 50% kind of return over the next 3 years. And, when you think of the, that's assuming the correlation stays the same as it has been for the past sort of 10 or so years post GFC. Now, when you think of the headwinds that the sector's had in the last 10 years, from increased capital requirements, increased regulations and the cost of regulation, fines, litigation, obviously lower negative interest rates, that's been a decade of misery for bank investors, obviously particularly in the UK. You think about PPI, etc., the ring fencing of banks. And what we're saying is, even if what this chart is saying is, even if you continue to have a pretty difficult environment for the bank sector, well, this would suggest you should actually eke out some pretty decent returns going forward over the next few years. Add that into the tailwinds you've got, then actually we think there's a very interesting setup at this point of the cycle. So I've spoken quite a lot. I'm happy to continue. I just wondered if you want to step in and.
Yeah, I mean, I'm looking at this, and the sort of first thing that sort of jumps out at me is that obviously PCFT was established to obviously play the expected recovery in the financials sector, but where we sort of find ourselves today, that still looks like it's got a long way to run. I mean, is that how you're looking at it?
Yeah, I mean, I think understandably the sectors fell sharply going into the pandemic. It's a 1 in 100 year event. People understandably concerned, the consequence of that, business failures, etc. You then saw, incredibly sharp recovery, particularly post the news when Pfizer came out with its, vaccine results, obviously helped by all the stimulus, from governments and central banks. And then we've, obviously the sector's then taken sold off again in the last sort of 3, 4, 5, 6 months over concerns about the outlook, quite understandably. And for us, I think the narrative, people are looking back. There's a narrative, if you're concerned about the outlook, generalist investors, quite understandably, you buy more defensive stocks, you sell some more of your cyclicals. Now, within the sector, we've got exposure, we can touch on this, to insurance sector, which tends to be much more counter-cyclical. Non-life companies, their losses are driven by obviously accidents, weather-related losses, etc., not by obviously economic cycles. But obviously the more cyclical part of the financial sector is banks, consumer finance, asset managers, and so forth. And for us, we're very constructive on the underlying stocks within the portfolio. It's the nature of the sector. It's going to sell off when there's concerns about growth. And we see that as an opportunity. Now, we can't say that, the market doesn't sell off again, or you see lower lows that we saw in the last couple of months. But certainly when you're buying into it, these kind of valuations, it makes it, it gives you a lot more confidence about the returns that you can expect. And looking at this chart, I mean, this is obviously 25 years. You can see that where it sits today, it's very much to the towards the bottom end of that that history. Even if we only took the last 10 years or so, today at the current price to book, the sectors only trade cheaper than this, about 20% of the time. If we looked at on a P multiple, then it's only ever traded cheaper than this on about 5% of the time, so 5 days out of 100. And that goes back to the earlier chart. You've had these positive earnings revisions come through because of higher interest rates. Now, obviously, you know the trust sector very well. I mean, today the trust is sitting on about a 7-8% discount. So if you looked at the bank's proportion of the trust on a look-through basis on that discount, then you're not buying it on a 1 in 5 cheapest on a price to book. It's more like 1 in 10, because obviously on a look-through basis, you're not buying it at 0.95, 0.96 times book. You're buying it 0.9 or below. And on a PE, out of, taking the last 10 years, so, that's about 2,600 days, 260 days a year, 2,600 days for 10 years. There's only 22 days over that period the sector's traded on a lower multiple,
right?
Which is incredible. Now, you've got to obviously take that, you've got to be sensible. Some of those earnings, you might see some negative earnings revisions over the next 6 months or so, on the basis that, growth outlook is obviously pretty poor. You've got to expect loan losses to pick up, and that's going to obviously impact, earnings at the margin. But this sector is obviously, that I think that highlights its pricing in a lot of bad news already.
Yeah. I suppose just sort of within that context, when you just start talking about financials, we've touched on it already, but you do tend to think of things being sort of relatively cyclical or sort of pro-cyclical. From sort of what you've described, would you say that PCFT's portfolio is possibly more defensive than people think it is?
It's a great question. Yeah, I think fundamentally, when we look at the underlying, we're balance sheet investors. When you're looking at banks or insurers, these are risk businesses.
Yeah.
So it's, understanding that those companies have got plenty of capital, plenty of funding, are underwriting risk prudently, whether that's, loans or whether that's insurance risks, and, but generating a good risk-adjusted return. Now, the problem is, some of it's driven by accounting. So we've got changes in accounting rules, IFRS 9 in Europe, which makes provisioning for loans much more, I suppose, driven by the numbers or outlook rather than the realities. We saw this in the pandemic. Banks took huge provisions, which turned out to be unnecessary, thankfully. And therefore had to, a lot of these provisions have been written back, but not all of them.
Yeah.
And so that gives us, when you see the volatility in earnings, and that naturally people makes them much more cautious. But also within the, within the trust, we own things like MasterCard and Visa, so payment businesses. We've got exposure to insurance companies. So in the UK, they might include Beazley and Lancashire, obviously specialists, Lloyd's businesses, or Chubb and Arch in the US, and they provide a lot, a lot of, I suppose, defensive characteristics, within the portfolio to balance that risk. So we're always consciously thinking about risk, not putting a lot of money on, maybe a couple of small esoteric banks, whether it's emerging markets or small US or European banks, but diversifying that risk, thinking about it as a just, as a balance sheet and where those risks are.
Yeah.
But the volatility around the share prices, you appreciate, the trust sector. I mean, that's a risk, but also it's an opportunity. And to the structure of the trust, the trust, we've been buying back shares recently, but it's also, there was a restructuring back in 2020, where originally the trust was launched with a fixed life to 2020. It was extended in 2020 to be indefinite, but subject to regular 5-yearly tender offers at NAV. The next one's in June 2025. There's a 100% tender offer then at NAV, less a small amount for costs. So you've got that certainty that if you're buying today on a 7, 8, 9% discount, yes, as we know, discounts can always widen, but just shy of 3 years' time, there's a date with destiny where you can, you'll be certain of getting something close to NAV.
Yeah. We sort of touched on some of this. I think it's sort of quite interesting. Previously, as I remember, this benefited quite well, both in terms of obviously what was happening to the underlying assets, and in terms of its also demand for its own shares and sort of narrowing the discount. When the yield curve was tightening, I mean, do you have a view on what's going to happen to the yield curve? I mean, do we think that we might actually see a sort of near-term steepening of that? Is that a remote possibility?
Yes, I mean, we can't escape. The sector is, going back to that preceding chart, the shape yes, so, the shape of the yield curve, where where bond yields are, does have a big impact on the sector, but in the sense that it's a leading indicator.
Mm-hmm.
And I think the biggest impact on the sector in the short term is, what's the outlook for growth? Are we going into a shallow recession, short or long, or is it going to be much more deeper because of obviously what's happened with energy prices, and so forth, subject to how central banks react to it.
Mm-hmm.
So to the extent that people buy in that maybe inflation has peaked, coming back to obviously the market having that recovery we've seen in recent weeks post the latest US CPI numbers. And if they then buy into, obviously we'll find out what Powell says this afternoon.
Mm-hmm.
If they think that means maybe we've seen that interest rates won't be going up materially further, or it all depends on their hold, then that's probably very positive for the sector.
Yeah.
The shape of the yield curve probably matters less, in the sense that though people quite often get confused, they talk about banks borrow short end, lend long, so you have this maturity transformation. So a steeper yield curve is good for the banking sector. It is, but it's actually less material than the front end. 70% on average of banks' earnings are driven by the front end of the curve.
Yeah.
And obviously a steeper yield curve is helpful, but that's less important.
Yeah. Okay. I think there's obviously more we can discuss around that, but there's quite a few questions coming in. So probably like to have a look at some of those now, if you don't mind. So probably on the macro thing, there's a sort of question here. Do you agree that central banks have been too slow to act in response to rising inflation? And what do you expect, or do you have an expectation for them for the remainder of the year?
Yeah, no, I mean, completely. Obviously the counterfactual is always, you can argue whatever you like, but I think there are a number of people were making the case early on in 2021 that central banks should be raising rates. Not, in particular, the former chief economist of the Bank of England, Andy Haldane, mentioned it as he was leaving, but yep. Some strategists out there. So yes, I think they're behind the curve. The degree to which, if they had raised rates or stopped QE earlier, what impact that would have, obviously is an unknown, but it certainly would have had some impact. Mm-hmm. Outlook for here, I think it is a tough one, because to quote the sort of Irish phrase, where do you go from here? Well, you don't start from here, really, in an ideal situation. Yeah. But I think it's going to be very difficult for central banks to pivot in a more dovish way, because they've got it wrong, because they've been behind the curve. They need to see inflation expectations and inflation numbers start to moderate quickly. Now, there's some good reason to expect that to happen with, obviously commodity prices coming down. So you can see, headline inflation starting to come back quite quickly, but core inflation, well, there's a risk that stays much stickier. Delay in obviously wage bargaining, wage pressure, the ability that corporates have found it much easier to raise prices in some cases, not all. So there's still this is still a big question mark out there, and I think that's always a good reason to remain cautious for that reason. Yeah. Okay.
There's another probably sort of interesting question related to this is, how have the sort of smaller versus the mid cap versus the larger banks cope with this environment? Has there sort of been any difference?
I mean, the short answer is it is a yes and a no, in the sense that it's a mix effect. So when you look at a lot of the larger banks, they tend to have, to varying degrees, much bigger investment banking operations, or whether that's large corporate, whether it's a JP Morgan, Bank of America, or in the UK, obviously, Barclays or an HSBC, etc. Less so, obviously, Lloyd's and some others.
Mm-hmm.
So those larger banks have been impacted by obviously a sharp slowdown in equity capital markets, debt capital markets activity, slightly offset by better sort of fixed income, trading revenues. But within the sort of the core lending to businesses, individuals, mortgage lending, then you haven't really seen much difference. Outside competitive pressures or mix effects. That's been the big surprise. Loan growth, a side effect of higher inflation, loan growth has been coming through much stronger, sort of just almost touching double-digit figures in the US. Obviously with higher inflation, everything just costs more. So if a company needs a working capital line, or they need a facility to pay for inventory, that inventory is costing more. The plant machinery is costing more. But yeah, I mean, you haven't. So that key difference, and then the key difference on how the share price reaction. Oversimplistically, small banks lend to more smaller businesses. Smaller businesses are probably more prone to a recession, and they've seen share prices fall a bit more.
Right.
But that would be a big generalization.
Okay, super. Now, obviously, with talk of rising interest rates or ongoing rising interest rates, and talk that this could tip the sort of global economy into recession, we've sort of got a question here that says, have you sort of changed the portfolio in a way to sort of navigate a possible recession? Has there been an increase in turnover? Have you tweaked it much?
Yeah, so we did a lot of changes during the pandemic, for understandable reasons. There's a lot of volatility. This year, we have post obviously the sad events in Ukraine. We have pulled back from some European bank exposure, for understandable reasons. The impact on obviously higher energy prices and indirect, costs of the war. So that's where we've been a bit more cautious. So our bank exposure has probably come back from around 65% to about 58%. Increased our exposure to insurance and one of the payment companies at the margin, but I suppose more so insurance. Again, because of that, they're more defensive, attributes in a in a difficult market. And also you're seeing some good trends in the insurance sector. So outside UK motor, where we've seen a couple of profit warnings, insurance rates have been rising quite rapidly over the last few years. It's exacerbated by the events in the pandemic around business interruption claims. And naturally that's where money has flowed in this year. And you've seen a little bit of M&A there as well, which has helped.
Okay. In my head, I think the answer to this is no, but maybe this will educate me. There's a question here that says, do you hold any of the Chinese banks? And if so, do you have concerns over regulation, etc.? Do you have any Chinese banks?
So we don't have any exposure to Chinese banks. I suppose there's a broader question around China. We do have some exposure to the UK Asian banks, so HSBC, Standard Chartered. We have some, DBS, which is one of Singapore's largest banks. Obviously, indirectly, they do have exposure to China and property companies. I mean, it is small. So, I mean, you take, HSBC, it's got just shy of $20 billion exposed to Chinese property companies. That's about 2% of their loan book. I mean, they'd say it's not the Chinese property companies that are most exposed, obviously in the news. So, yeah, there's indirectly some exposure there. On the regulatory front, if I heard the question correctly, then I suppose it's more an issue, for HSBC being pulled in two different directions. And more recently, there's been pressure on them to consider breaking up, and whether a breakup would create value. HSBC say no, In this case, the shareholder in question, disagrees. It's probably somewhere in the middle. But so that is a longer term question. I think we've seen what's happened with Russia and Russian companies' exposure to Russian banks or whatever, loans to Russian companies. Then there is obviously there is risks there that you've got to be aware of longer term.
Yeah, no, absolutely. Interesting question here. I think you probably have to have a particularly long memory to think back to perhaps when interest rates were high, because it seems to have been a long time ago. It says, is there a point where higher interest rates can become detrimental for the financial sector? I mean, I'm old enough to remember us falling out of the exchange rate mechanism and how sort of interest rates very briefly spiked up to ridiculous sort of levels then. I mean, do you have a view on that?
Yeah, it's a very good question. The short answer is yes. Obviously, there is an impact. At a certain level. The positive, we haven't got a chart in the pack we're showing today, but you saw affordability collapse to historical, low levels, as in affordability for mortgages, loans, etc., because of during the pandemic, because obviously the fall in interest rates. Now that has reversed. When we've spoken to banks, you get different answers. In the past, they've said maybe 3%, maybe 4% before you start to have concerns about delinquency trends. Really, the big driver is unemployment. So corporates pulling back on hiring. If interest rates go up, people can normally manage. They cut back on their spending. They go out less. They maybe don't, have a holiday abroad or don't have 2 or 3 holidays. And that therefore affects small businesses, first.
Right.
But yeah, I mean, I think you need interest rates to go up, and you are going to start seeing, obviously, again, exacerbated by the energy squeeze. You're going to start to see people struggle. But the amazing thing is, we haven't seen anything yet.
Okay, brilliant. Probably sort of quite an interesting question, just in light of what we were saying about valuations, etc. It says, how are you using gearing at the moment? I mean, because then the sort of broader question is, given valuations, have you taken the sort of opportunity to expand it, perhaps meaningfully or otherwise?
So gearing has ranged from about 0 to sort of 12% over the life of the trust to date. We took it up during the pandemic when obviously the sector, along with everything else, fell sharply. Valuations got extremely cheap, got up to around 12%. We started taking it back down about a year ago. Coming into the beginning of this year, it was probably around 6%. It's now about 2.5%, 3%. So notwithstanding that valuations are cheap, and in some cases extremely cheap, we've kept it at the low end because we just want to have a bit more confidence on the outlook before we take it back. It's either that, or we need to see valuations go lower, or at least, I suppose, some analysts take down their numbers on stocks to see a bit more what feels to be a bit more reasonable before we take it up from where it is at the moment.
Yeah. Okay. That makes sense. Probably another sort of macro related question here. It says sort of financials is generally a value sector. It's done well year to date. There are some companies, the growth stocks, which have in turn fallen sharply. What is PCFT's typical split between these types of stocks, and has this changed in response to the rotation from growth to value? I mean, I would have thought that perhaps some of the fintech stuff that you have is perhaps a bit more growthy. Do you have a view on that?
Yes, I mean, you inescapably, financials are a value sector, and to the question, but yes, you've got. I mean, the payment companies that we own are currently off benchmark. So Visa, MasterCard, PayPal, about 5% of the trust. March next year, MSCI and S&P are moving them out of the technology sector into the financial sector. So that will slightly change. But notwithstanding that, there's some other companies like MSCI, S&P, some of the asset managers do trade on higher multiples. Within the way we're positioned versus our benchmark is we have a quality bias. We like, companies, or certainly the balance sheet businesses, the banks, insurers, that have stronger capital, stronger funding, better profitability. They tend to trade at slightly higher multiples, understandably. They've got better capital. And you have to pay, obviously, a little bit more for that quality bias, but we think that's the right thing to do. And within that, we've got a bit more exposure to some of those growth names as well. So there's a little bit of a growth. There is an opportunity. We've seen some of these fall back a long, long way. And we've used that to add a little bit to holdings cautiously across the fund. But it's not quite yet where I'd say we'll be, thumping the table to say it's a time to go, really, really aggressive. And you'd see that if we were taking the gearing back up.
Yeah, no, that makes a lot of sense. At this point, we are approaching the hour, and I think we've actually covered a lot of ground. So it's probably not a bad time to wrap up. Apologies to anybody if we didn't quite get to your question. I think we've got most of them. We'll see what we can do to answer some of those. But sort of thanks, Nick. As I say, I think that's given us a really, really interesting look at PCFT and just, some decent insight into the macro, so what's going on at the moment, and so we'll sort of see what MPC says this afternoon, etc. In terms of other stuff we've got sort of going on, as I say, there are sort of plenty of events that we're hosting. We've got plenty of people coming on in the next few weeks. If you just have a quick look at this, we've got Tim Levine from Augmentum FinTech sort of next week, so that will be quite interesting, certainly in the context of having had some Nick on this week. And obviously Andrew McCarthy will be in to do his roundup of the month, as I said earlier. Jane is going to be hosting that one. 9th September, we've got Joe Belfry in to talk about AVI Global. And then on the 16th, Stuart Gray to talk about Alliance Trust. And then, as I say, there's another couple in September, Matthew Sillers, Bearing Emerging EMEA Opportunities, and then Masaki Sakasumi on the 30th of September to talk about Schroeder Japan growth. So we have got plenty of stuff that we've put in the hopper. You'll be able to enjoy it over the next month or so. As always, if there are people that you'd really like to hear from, just let us know and we'll see if we can get them on. As we sort of move into October and November, we've got our 2022 property conference and investment strategy conference and the responsible investing conference, and reflecting what's happening. These are actually going to be sort of our first face-to-face events. So hope to be able to see some of you at those. Sort of once again, thanks to Nick and thank you all for joining, and thanks for the sort of really interesting questions. As I say, Jana will be back next week to present the show, and we'll see you then. Thanks, bye.